Your job safe? Well, it may not be if the Federal Reserve gets their way. Federal Reserve Chairman Jerome Powell recently said that we need to act now forthrightly, strongly, as we have been doing. My colleagues and I are strongly committed to this project and will keep at it until the job is done. What job is that? Fighting inflation. The only problem with that is that inflation may only be stopped at the cost of you losing your job, considering that the US may need a 7.5% unemployment rate just to curb inflation. Which means that the Fed is strongly committed to fighting inflation until the job is done, which also means until your job is gone.
On Thursday, following reports that the Federal Reserve would likely soon jack up federal interest rates, again, this time by 75 percentage points, Chairman Jerome Powell tried to allay fears that the Fed's strategy would cause an economic downturn, insisting that another rate hike was unlikely to cause a deep recession. The interest rate hikes, which nominally serve as a way for Federal Reserve to tamp down inflation, are also a way to put economic power back into the hands of the very rich by driving up unemployment, since higher interest rates make it more expensive for banks to loan people and businesses money, leading to scarcer investment and therefore fewer jobs. Despite Powell's assurance, many economists worry that the Feds will have to allow unemployment to rise much more than is currently expected. To get inflation back to its 2% target, the Fed has projected that unemployment will rise 4.1% by the end of 2024. As higher rates bring down inflation, new research released Thursday under the auspices of the Brookings Institution says that such a scenario requires quite optimistic assumptions and finds that unemployment may have to rise much higher to bring inflation down. Let's see more and get more information, and also see how Chair Jerome Powell evades responsibility again. Editor, pro clip, fair use.
Manage this process out of your hands? To the extent that there continue to be labor shortages, does that then feed into expectations that the public has about inflation, as you mentioned very prominently?
Well, I think you're right that if it does turn out that we are in a world of a persistent labor shortage over time, that'll be a challenging world for companies, and it will certainly create upward pressure on wages and that sort of thing. Today, the labor market demand is very, very strong still in the labor market. We're still printing new payroll job numbers at a high level. Wages are running at elevated levels. And so we think by our policy interventions, what we hope to achieve is a period of growth below trend, which will cause the labor market to get back into better balance. And that will bring wages back down to levels that are more consistent with 2% inflation over time.
That is bullshit.
That's what we're trying to achieve. The shock to labor supply that we got from the pandemic was large and unexpected, and unfortunately persistent. I will say that just in the very last labor market report that we got last Friday, we did see a welcome increase in labor force participation. Nonetheless, still a full percentage point below where it was before the crisis. And I think it's important as a society that we have measures in place to support a strong labor market and high labor force participation. And that goes beyond what we can accomplish with monetary policy.
Good afternoon, everybody. Uneducated economist here. So, I just keep feeling like a broken record a lot of times when I come out here and I kind of give you the same information over and over again. But so much is now starting to take place that I had predicted before. And it's not hard to really predict what the Federal Reserve is going to do if you read the Federal Reserve speeches. Now, the Federal Reserve uses something called jawboning, forward guidance. I call it credible threats. Now, this is how they use their monetary policy, because they know that dropping of interest rates was no longer an effective tool because they were going to run into the lower bound of zero, meaning dropping of interest rates was no longer going to stimulate the economy to get people to go out there and borrow money to buy houses and cars and go on vacation and do that kind of thing. So they knew that they were going to try and get the markets to have an expectation of what's going to come. And now part of that expectation is inflation expectation. And that is really where inflation comes from, is from this expectation that there is going to be inflation coming into the future. And then people start to behave in a way that actually causes the inflation to take place. Now, I know a lot of people are going to argue with this. Money printer go burr, prices go up. What else do you need to look at? Now, that's what a lot of people are going to say. But there is a lot that goes into what makes a dollar strong.
To go to this current situation. So as part of our response to the pandemic, we did resort to large asset purchases to address what were pretty severe disruptions in markets, and then also to support the economy, and our balance sheet expanded dramatically. But remember that our purchases of securities don't actually increase the quantity of government obligations held by the public. They really change the mix because we issue bank reserves to pay for those securities. So we're not changing, the quantity of obligations. That is not to say that money growth wasn't high. It was, of course, extraordinarily high in 2020, and then slowed down in 21, and now is quite sluggish. And I guess I would just say it this way: whatever caused, there are different theories on what caused the inflation that so suddenly jumped up.
You can't make this shit up, people. You cannot make this shit up.
Out of the ground in March of 2021, whatever that cause was, the relationship between the money supply and inflation, economic output, has been much more unstable than it was in Friedman's day for a very long time. And so literally changes in monetary aggregates have not had a consistent, reliable relationship. They haven't been a good predictor of the economy or of inflation. Now, of course, the economy is ever changing, and that too could change, to where it is important again. But for now, and for really many years now, monetary aggregates don't play an important role in our formulation of policy, and we don't think they're generally a good way to think about policy or about inflation. It's more about demand and supply and things like that. So that's where we would be on that.
Higher interest rates, slower growth, and softer labor conditions will bring down inflation. They will also bring some pain to households and businesses.
Hey guys, it's Jose, your regular Joe Blow again, keeping an eye out and my ears open to the words that come out of the Fed's mouth, particularly Chairman Jerome Powell. From transitory to we are on target with price stability, we are ready to use our tools, to now we are going to feel pain, and then not knowing where inflation came from, equals we are in big trouble. If we are not preparing ourselves and our families, guys, at least they are telling us by bullshitting us, meaning we are always and have been on our own. Do your research and thrive in these crazy times, because I will, and I will be praying for you guys too. Thank you guys. Thank you so much for the support, and for real guys, really, stay free.
It ain't hard to tell, I excel, then prevail.